Hello again, everyone. Welcome back to the program. My name is Jeff. Sorry for the lighting, but it's so you can see this thing a little bit better. Notice my background's a little bit different today. I have a whiteboard. And the reason I have a whiteboard is I'm going to talk about the stock market. I'm going to talk about, which I never talk about, but I'm going to today in a particular reason. Because I'm the economic prepper. I talk about different things in the economy to use to strengthen your value. This is not financial advice. I'm going to talk about a particular company that is leveraging the stock market to buy more Bitcoin and increase their Bitcoin holdings. I'm sure you know what the company is. It's MicroStrategy. I'll put that ticker up here. That is MSTR. You may see that dollar sign in front of it on Twitter, but it's MSTR. Let's see. I'm trying to make sure everything's legible. Hey, you can read the MSTR. So the MSTR, you may see a dollar sign in front of it on Twitter, and also Bitcoin. Okay, that's the two things we're going to talk about. And we're going to talk about MicroStrategies, and we're going to talk about what Michael Saylor is doing in the marketplace that's different than other companies. And this is why people are not quite getting what MicroStrategy's strategy, sorry for the redundant words there, but what their approach is, what they're doing. And you have to pick your words carefully, because some people say you're leveraging. Well, that's risky. You don't want to do that. Or you're making loans, making debt. There are things that he's doing that make perfect sense if you understand Bitcoin and you understand the capital markets, but you have to understand both to really get an idea of where MicroStrategy is going, what they're headed, what they're doing. So I'm going to create a very simple, basic example. I did something like this on Twitter. This is how this video came to be. Someone asked me to make a video about this. So let's pick a company. I'm just going to create a company, and I'm not going to name it as any particular company. Again, this is not financial advice. I don't own MicroStrategies presently. Obviously, I own some Bitcoin because I'm a Bitcoiner. I've been on this channel for years. You guys know that. But you might be new here. So this is not financial advice. This is just me drawing numbers on a whiteboard and talking to you guys, doing some math. Think of me like a professor giving a lecture. This is my opinion. There's no lesson plan here. Pick whatever you like from this. Hopefully you get something valuable and you subscribe, share the video, all that cool stuff. But I'm trying to help here, okay? So let's just start. We're going to start with the example of a generic company, okay? This company, I'm going to call it Company Z, all right? So Company Z is worth $80 billion, all right? 80 billion bucks. That is its market cap, or M cap. Make it a little simple. It's the market cap. So what's a market cap for those you don't know? $80 billion, that is the price of the shares times the number of shares. So in other words, if you wanted to buy all the shares in existence of the company, this is what it would cost. So to make things simple, I'm going to say the number of shares is 800 million. Now, why would I pick that number? It makes the math easy. 800 million times $100, right, equals 80 billion. So the share price, the share price, that's 80 billion over 800 million. That's $100 per share. Okay? Hopefully you're with me. $100 a share. That's the important number. $100 a share. So we're going to go at the top. We have $100 per share. Now we need one more fact. Okay? Well, that is, this company also has underlying assets. Now, generic Company Z could have assets in gold, real estate, oil, commodities, whatever they have. It could be cash too, but we like assets more than cash because cash loses value in an inflationary environment. That's why we don't like holding in cash. But to operate a business, you have to have some liquid cash. I would get that. But let's just say that they have an asset worth $20 billion. They have assets worth $20 billion. Now, in this particular example, we're going to get to, that's going to be in Bitcoin. But I just want to show the relative value of the assets compared to the share price. So the company's worth 80 billion. That's assets in 20 billion. 20 over 80, that's 2 over 8. That's 1 over 4. That's 25%. So 25% of the value of the company is its assets. The market has decided this. The market says you're worth $80 billion as a company. That's $100 a share. But a quarter of that is your asset value. So the asset value is 25 per share. Okay? So I have assets worth $25. So now I have stock price and assets. And I get the number of shares. Now, I decide for my company, I'm the CEO, or I meet with my board, the board decides, shareholders vote, whatever, however this comes to be. But there's an agreement that says we're going to increase the number of shares to 1 billion shares. We're going to go up by 25%. So this number of shares is, let's see if I can get another color. Let's see if another color will work on this. We'll try it. All right. So we're going to go to 1,000 million, which is a billion. Okay. So I didn't change the market cap, right? The value of the company is still the number of shares times the price of the share. So the natural stock market move here is to lower the share price to bring it back to 80 billion. Because let's just say you wake up, you go to bed, market's closed on a Friday, right? The company's worth $80 billion. Come Monday, there's 1,000 million or a billion shares instead of 800 million. You're going up by 25%. The market needs to rebalance this because nothing special happened between Friday and Monday. The company's still worth 80 billion, but now there's more shares. So now you got to do the math to say, okay, instead of $100 a share, what is it going to work out to be? Well, it works out to be $80 a share. Okay, 80 times 1,000 million, or 80 times 1 billion, that equals 1 billion. Let's make it easy. 1 billion. 1 billion times 80 equals 80 billion. So now my price per share has gone down to 80 per share. This is why the stock market worries about selling more shares from a company, because it will dilute every shareholder. The shareholder's value will go down by the percentage of shares that go up. If I double the number of shares, the price of the share should go in half. That's why they don't like it. That's why they use like the term like dilution. So the question really becomes, the company raised capital by selling these shares. Now, if this happened overnight, if you just, there's a billion shares and it went to $80 a share overnight, then the company wouldn't really be able to realize much value, not as much as they wanted. But they still have these extra 200 million on their books. They have 200 million that they say now exists now, because the difference between this billion and 800 million, there's 200 million shares now. 200 million shares times 80, you're at $16 billion of capital raised. $16 billion has been raised by selling those shares. What do you do with that? Well, your original thought was like, well, the company is worth 800 million. I want to sell more shares than $100 a share. I'm going to sell 200 million shares. I'm going to raise 20 billion. But the market said, nah, we're going to drop you down to 16 billion. But the company raised $16 billion because of that 200 million extra shares. Hopefully you follow that. So they went from, I'm going to say it a different way so you capture it, because it can be complicated here. The company said, we're going to add more shares. They have those shares. That's just the number, the difference. That price that they wanted for was, like, they hoped to get that $100 a share, which it was before there were extra shares. But the market said, no, thank you. We're going to value lower because there's more shares. So now the shares are only worth $80, not 100. So $80 times 200 million raises $16 billion. Now, Company Z is smart, and they said, we're going to take all 16 billion and we're going to add it to the asset part. We're going to take this and add it over here. So what they've done is their assets went, they were hoping for 40, but what they really got was 16 plus 20. They were hoping to get this up to 40, right? But they really only got to 36, which isn't terrible, but we'll talk about that in a second. So now we have $36 billion in assets. Now, I've got $36 billion in assets, okay, and 1 billion shares. So the asset per share is $36, because again, $36 billion of assets divided by 1 billion shares, that's $36 per share is my asset. So up to the top, I have increased, hopefully 36, there we go, $36 a share are my assets, okay? So I've done all this math. I'm going to reduce this down a little bit, go back to the black, I guess, here. And so now my share price has dropped, right? All the shareholders are mad, right? They're like, I paid $100 for this share last week and now it's 80 bucks. Well, what happened was you paid $100 per share and got $25 worth of Bitcoin. Now your share is worth less, but you have more assets, okay? Even if you paid $100 per share, you have 36% of your stock is now an asset instead of 25. 25 divided by 100 is 25%, and now you're at 36. So now if you buy in at 80, if you happen to buy in at 80 and you get this new price, that's 45%. 36 over 80 is 45% of your stock price is now an asset. In other words, your Bitcoin per share has gone up. All right, I know that's complicated. I'm going to reduce all this down. This is where we're at, okay? So let me just wipe all this bottom part here. Hopefully you're with me. If you have questions, please leave in the comments. I'll probably be making up a follow-up video just to answer questions. But I'm just going to start here. Okay, I went from $100 per share, okay, with Company Z. $100 per share with assets of $25 a share. I sold that's before, now this is the after. After the stock price went down to $80 a share, stockholders are not happy because traditional stock market owners, they only see that, hey, I spent $100 and I only have $80 worth of stuff. That's not good. Okay, that's bad. You lost 25% of your value. You lost $20 on every share, but your Bitcoin value went up. So again, if you don't believe in the asset that's being purchased underneath the stock, what the company is doing, if you don't understand what the company is doing, then you shouldn't probably, not financial advice, but you probably shouldn't be invested in them if you don't understand it. So that's what I'm trying to explain. Their goal here, and Michael Saylor has made it very clear with MicroStrategies, get as much Bitcoin per share as we can. We want to keep adding more Bitcoin to the pile. That's why they're not liquidating, picking my words carefully. That's why they're providing to the market more stock to purchase. And again, that is typically viewed in the marketplace as a negative because the stock price in the short term will go down. But because of the capital that they're raising capital by doing this, and they're adding to share value, which is, very transparent because they announce every time they buy Bitcoin. So your Bitcoin is going up per share. So I'm going to write this as a very simple algebra formula because there's a factor I need to incorporate. I'll get to that in a moment. All right, hopefully you're with me. Hope you like this. If you like this kind of content, please let me know. So I'm going to write this as algebra. So share price, all right? Okay, the share price is $100. Okay, $100 equals the core value of the company plus the asset value. All right, it's probably more factors to do this, but C plus A. Okay, there's two answers to this. First off, the original answer to this was that $100, so that's the stock price. So let's just change this to stock price equals core value plus asset value. Okay? So that's not easy to read. Core plus asset value. So if I have a core value and an asset value, the original equation showed that I had $100 per share. I had an asset value of $25 a share. Wow, I really need a different marker. Okay, so my asset value was $25 per share. Okay, so we can solve what core value is. 100 minus 25 is 75. So the core value is 75. So now we know what the core value. This is the core value of the company. The company, like this is what is the company worth minus its assets. Okay. In the case of this example, Company Z, the core value is 75. So now I've got a new share price because I added more shares. My new stock price is 80. Okay. The core value of the company is still, it's not 75. Okay. You need to figure, so 75% of the core value. So originally the company was worth 80 billion and I had 20 billion in assets, which means that $60 billion is its core value. It's probably easier to do it on the big numbers because per share, this is going to go down, right? So I originally had 800 million shares. Now I've got 1 billion shares. So now I've increased the share population by 25%, which means this number needs to go down. So because I made everything in 1 billion share before, with a billion shares, this is now 60. And it's 60 times a billion is 60 billion. So it matches up. And also if you take 25% off of 75, you get 60. So it all adds up. So the core value is now 60 per share, which was established by the market back when the price was 100. We know that the core value of the company is three quarters. It was 60 billion. It was 3/4 of the of the value of the company. It was $60 billion. The company was worth 80 billion. Yeah, it's worth 60 billion. That's important. So the core value is 60 billion out of 80 billion. Now I've increased the number of shares, but I bought more assets. The assets went up. So the assets now went up to 36 billion, if you remember what I just did earlier. So now this is 36. Okay, you see that this is not equal anymore, right? We're not equal anymore. But we determined what this is, right? We determined what the value per share of the core value of the company is. It's 60, right? Because we went down 25%, okay? The core value of the company didn't change. All we did was add more assets per share. So now this doesn't match. So what happens is if the stock market drives this price down to 80, which they might, which a lot of traditional investors would say, you've added 25% more shares, we're going to punish the price by 25%. But what happens, people look at what's happened here, and you reevaluate it based on this, that's 96. So now this number really should be 96. So the price will go from 100 down to 80 up to 96. And it may happen quickly. It may balance out. It may never actually get to 80. People may realize this and say, we need to bump that up. Because the real value is 96 because we know what this asset is. We know what the core value of the company is because we can calculate it. But from before we added more shares, we knew the core value of the business is 60 billion and we have 1 billion shares. So that's $60 per share. So the core value. So by adding to the asset per share, the share price should go back up. So now it's almost back where it was, 96 versus 100. Now I'm going to go, so hopefully you follow that. That's why people are concerned about adding more shares, selling more shares. And then the first reaction, the first level of understanding will be drive the price down because the market cap should remain the same. Now, market cap should go, the price per share should go back up to close to where it was because I've added more assets. Okay? Now I'm going to add one more thing. Okay? Which is, let's go back to this equation. You got stock price equals core value plus asset value. Now, there's also something called, this is sometimes called net asset value, NAV. There's also a term called M. All right, that's a multiplier factor. M times asset value. Now, to some people, that's really hard to read. So you got the core value plus a multiple of the asset value. So core value plus M or multiple of the asset value. Okay? I'll abbreviate that AV. So the core value doesn't change. The company's still the same. Still that's 60 billion. Got that. And then you got the value of the assets. Now, if you wanted to return to normalcy, the asset needs to go up to 40 billion. So it needs to go up about 10, 11% to get back to that $100 of equilibrium. So you didn't lose money. But there's this term called M that people always try to calculate. And that is a multiplier on your asset value because the company has these assets and they can leverage them. Again, a bad term. They can utilize them to gain more value. They could put them to work. They can loan against them. They can borrow against them. They can do lots of different things to create more value. They could issue more shares. They could lots of different things. But that's an asset. If I'm going to change it to real estate. Let's just say the company bought $16 billion of real estate. They could borrow against that real estate, use that capital raise, and then add more assets and keep going. Similar to like owning trying to buy the entire strip of Las Vegas. Okay, say you own one really valuable property there, and you buy another, then you borrow against that. Now you have more capital by a third, and you just keep going and going. So this is a multiplier factor. People were trying to figure out what that is. Now, I've heard numbers. Anywhere, the bottom line is 1. We just did 1, right? The M didn't exist. So we did 75 and 25. That's the asset value. If M equals 1, so let's go over it here. So if M equals 1, we had the core value, which doesn't change. That's, I'm going to say 60 per share. And then the asset value, right? That's the value of the shares per the asset value. That's 36, all right? So the share price, I'm going to make a little more room. So price per share, that's 96. You just add these two. Now, conservatively, I've seen this as 1.2, right? M times 1.2. At 1.2, now you multiply this by 36 and you get 1.2, you get another 7.2. Now you're at 43.2. So now you're at 103.2 if you use a multiplier of 1.2, right? You're already above the $100 because you had an asset that has a multiplying factor. Now, I've seen this number at 2, 3, and so on. But a lot of people like look between 2 and 3, maybe even down like in the ones. But just say if it's 2, 2 times 36 is 72. The core business hasn't changed. So now your share price should be 132. For those who view the value by using this math, that doesn't mean that's what the price is in the market. The price in the market, we saw it, was $80. But the value is 132 if you agree that multiplier is 2. If you think it's only 1.2, well, the value is really 103 and you can buy it for 80. So that's why people are encouraged by MicroStrategy, because they are able to recapitalize themselves by introducing more shares into the market. And there's other vehicles they do that with bonds and other convertible notes and other things to raise capital. But they're raising capital to buy assets in the asset class that they believe is the best asset going forward, which is Bitcoin. And the multiplier on that Bitcoin is still being discovered, but we know it's greater than 1. Whenever you do this kind of math, it's always greater than 1. But even at 1, you're not far off from, you're in a profit if you do this. Now, the reason the price has gone down recently for MicroStrategies for the last several months is they're raising a lot of capital. They keep doing this. They keep raising more capital. The market's punishing them because they think they're viewing them as diluting the share value to the shareholder. But they're adding to the asset. So if you look at the asset, that's why people look at the Bitcoin per share. That is the asset per share. As long as that continues to go up, you're buying it at a discount. So when things reach normalcy, let's say they stop doing this for a year, or they say they never do this again for the next 4 years. Those of you who have been following me, you understand Bitcoin, you get that Bitcoin is the best performing asset 11 of the last 14 years, and you always make money in a 4-year period. That's been proven by Bitcoin, those two facts. If that trend continues, the trend is your friend, but you don't know what the next 4 years are going to hold. But we see a lot of positivity coming. So if this value of Bitcoin continues to go up, so that this 20 billion, which becomes 36, and when they keep adding to it, that multiplying factor will continue to go up, which means the share price will continue to go up because the core value of the company isn't changing. The assets are growing because they're introducing more capital. They're gaining more capital by introducing more shares, which the marketplace, the traditional stock market does not understand that behavior. They don't understand. Typically, when you sell more shares, you're using it for working capital to operate your company, and that money gets spent. That's not what they're doing here. MicroStrategy is buying assets to increase assets per share. And as long as those assets continue to gain in value, then everybody will win. And I'll leave you with this. If you don't trust Michael Saylor's outlook, first off, you probably shouldn't be invested in MicroStrategies. And again, this is not financial advice. But keep in mind that the largest holder of MicroStrategy shares is Michael Saylor himself. So I'm pretty sure that he is in lockstep with shareholders by trying to create more value for all shareholders. And this is his methodology. Now, I know I did a lot of math here. I know there's a lot, but the core takeaway is this equation, right? The price per share is the core value, and I'm going to get rid of a lot of the other stuff here. The core value, the price per share is the core value of the company plus some multiple of the asset value, right? That is the underlying value. So the price equals the core value, which you can get at any point in time, plus some multiplier of the net asset value. And the assets can mean many different things, but what let me slow down and it's just amazing what he's doing. It's so funny that people don't see it. He's turning these into Bitcoin. These are a diminishing value asset. If people understand this, this is the Federal Reserve note dollar is a debt instrument that loses value every year at a minimum of 2%. Right? That's the inflation rate that they hope for. Right? We all know it's higher. So that is losing 2% or more a year. This is the highest performing asset class in 11 of the last 14 years. He's finding ways to create more of this, to acquire more of this, to improve the value to everyone that's invested in MicroStrategies. That is it in a nutshell. He's taking every way to raise more capital, to buy more Bitcoin, to add more assets to the company. And those assets to the company are a multiplicative adder to the value to the shareholders. That's it in a nutshell. So I look forward to all your questions. I'm sure you will have them. I'll read them all. Comment on Twitter. I'll share this on Twitter first because that's who asked for it. I'll put it on YouTube shortly thereafter. And Happy New Year. I hope this was valuable to you. If you have more questions, let me know. I'm sure I can make another clarification video and squeeze in here next to the whiteboard. So Happy New Year. See you next video. Take care.